Hi everyone, welcome back to another edition of the ACAP Recap, and today we're going to talk about the potential tax law changes that could go into effect in 2025. So with President Trump back in the Oval Office, one of the questions on many people's minds is, will there be new tax legislation? And if so, what's going to be included in that new tax legislation and how it's going to affect them? So right now, timing is really important because the Republican Party essentially has a trifecta. They control the House, the Senate, and the White House. This essentially gives them the ability to pass legislation smoother than they would have if there was a divided Congress. Now, the administration is very eager to pass something in 2025 because of the trifecta that I just mentioned, but more importantly, because of the tax law, the Tax Cuts and Jobs Act that was passed in 2017 under Trump's first term. Many of those provisions are set to expire at the end of this year. So unless new legislation is passed, those provisions will expire and it's going to affect millions of people. So I'm pretty confident we'll see a bill presented and passed this year in Congress, especially if Congress decides to utilize a reconciliation procedure that they did with the Tax Cuts and Jobs Act in 2017. So the reconciliation procedure is a special legislative tool that's used to streamline the process of passing budgetary bills. It's particularly useful in the Senate because it only requires a majority vote and it cannot be filibustered. Plus, debates on reconciliation procedure bills are capped at 20 hours, which avoids lengthy discussions on bills on the congressional floor. So in many ways, this is an efficient way of passing a budgetary process or a budgetary bill, especially in the Senate. Now, one of the biggest drawbacks of the reconciliation bill is this thing known as the Byrd rule. And I'm not referring to the bird that you see flying in your backyard in a tree. I'm talking about the bird that's named after Senator Byrd, B-Y-R-D, from the 1980s. Now, the Byrd rule essentially says that if a provision within a bill increases the deficit, that provision cannot exceed 10 years. This is the reason why many of the provisions of the Tax Cuts and Jobs Act of 2017 expire in the year 2026. It's because of the Byrd rule. And later on in the presentation, I'm going to go over many of the provisions of the Tax Cuts and Jobs Act that, unless Congress acts, are going to expire by the end of this year. During the campaign trail, President Trump, at that point candidate Trump, made a lot of promises on tax policy changes. But now that he's president, the big question is which of those proposals that he promised will actually go into a final bill this year. Now, of course, no one knows which of those promises are actually going to go into a final bill. But in this video, I'm going to go over each of those promises and talk about how it's going to impact you if they were to get passed. Now, what I'm not going to do is I'm not going to touch on how any of those proposals are going to impact the deficit or the budget. So instead, I'm only going to focus on the overall tax proposal and its impact on you. The most significant of the Trump proposals was the elimination of tax on Social Security benefits. Now, just to clarify, this isn't the elimination of the Social Security wage tax. This is the elimination on the tax that retirees pay on Social Security benefits, which is a big difference. For example, as an employee, you pay Social Security tax on your wages up to $176,100 of your wages in 2025. Those taxes that you pay to Social Security are used to pay people who are in retirement and are receiving benefits from when they were in the workforce and working. When we're talking about the elimination of the taxation of Social Security, we're talking about the people who are receiving those benefits, not the ones that are currently working and paying into Social Security. Another major promise that he made on a campaign trail that's gotten a lot of publicity is the no tax on tips. And he's continued to push this no tax on tips even until very recently at a campaign rally in Las Vegas while he's a president, not as a candidate. So this leads me to believe that it's likely we're going to see some sort of provision in the new bill that's going to have no tax on tips. Now, I don't know what that's going to look like, but it's very likely that some version of that may go into the final bill. So we'll just have to wait and see how that's going to unfold. No tax on overtime pay was also another talking point during the campaign trail. But similar to the no tax on tips proposal, the details of the no tax on overtime pay are pretty scarce. Now, exempting overtime pay from taxation could lead people to take on more shifts and extra shifts because you're not going to be taxed on that overtime pay. But it's also worth noting that the no tax on overtime is only going to affect people who are non-exempt and people who work hourly, because people who work as exempt employees don't get overtime anyway. So it's only people that are non-exempt that hourly that get overtime pay. The next item that I think is going to be in the final bill is going to be the repeal of the SALT cap deduction. And if you're not familiar with that, the SALT is the state and local income tax deduction that was eliminated during the Tax Cuts and Jobs Act in 2017. Before the Tax Cuts and Jobs Act, most individuals were able to deduct most, if not all, of their state and local income taxes and their property taxes. But after the Tax Cuts and Jobs Act, that was severely limited to a maximum of $10,000. And what ended up happening was that it punished states with high income taxes and high property taxes, such as New York and California. But with the 2024 elections bringing in a new wave of Republicans into the House from California and New York, I suspect they're going to hold back on their vote on a new bill until something in there reduces or eliminates the SALT cap deduction. So it's definitely something that's worth watching. This could also have a big impact on the PTE, or the pass-through entity tax, that a lot of states like California and New York passed, that allowed certain individuals within those states to essentially circumvent the SALT tax limitation, or the SALT cap limitation. So if the SALT deduction is eliminated, that cap is eliminated, the pass-through entity tax workaround will also get eliminated. And if you're not familiar with the SALT cap workaround or the pass-through entity tax, I did another video on that explaining it, especially the calculation of it, so you want to take a look at that. Deducting auto loan interest was another item that was brought up by then candidate Trump during a Detroit rally. But since then, there's been no other talk about it, so it's unsure whether or not that provision will get into the final bill. So we'll have to wait and see on whether or not you can deduct the interest that you pay on auto loans. If some reason the auto loan interest deduction does end up being in the final bill, what's uncertain is whether or not it's going to be an above-the-line deduction or a below-the-line deduction. An above-the-line deduction, which is highly unlikely, is a deduction that's taken before your adjusted gross income is calculated. But if it's a below-the-line deduction, then it's a deduction such as an itemized deduction that reduces your adjustable gross income. And an itemized deduction is things like mortgage interest, property taxes, and charitable deductions. Lowering the corporate tax rate was also another thing that was floated around during the campaign trail. See, before the Tax Cuts and Jobs Act, the corporate tax rate was a graduated rate with a top rate of 35%. But after the Tax Cuts and Jobs Act, it eliminated the graduated rate and it made it into a flat 21%. Now, the proposal during the campaign trail was to reduce that even further to 20%. And if the company manufactured their products in the US, the proposal was to lower it even further down to 15%. I mentioned earlier how some of the Tax Cuts and Jobs Act provisions are set to expire at the end of this year in 2025, which is why there's a sense of urgency to get some sort of legislation passed. But one of the things that's permanent is the corporate tax rate, the lowering of the corporate tax rate. So I suspect that lowering it even further may not be on the agenda during this tax cut season in 2025. Now, then candidate Trump had several other proposals that he made during the campaign trail to lower taxes. Some of them were targeted at reversing parts of the Inflation Reduction Act that was passed only a couple of years ago, specifically targeting reversing some of the green energy tax credits. Other proposals he made were to increase the bonus depreciation and also increase the deduction on research and development costs. But at this point, all these other proposals are still up in the air, so it's uncertain whether or not they're going to make it into some type of final legislation. I mentioned earlier that a large part of the Tax Cuts and Jobs Act is set to expire at the end of this year, which is why I think there's going to be a big sense of urgency in getting some sort of tax legislation passed. Now, I'm going to go over some of the items that are temporary, that are set to expire, and I'll also go over some of the ones that are permanent, that are not set to expire, which would most likely mean there's not going to be any changes on the permanent side, but definitely some on the ones that are temporary. The qualified business income deduction, also known as the QBI deduction, is a real big one. Trump has said many times, and even the Biden administration said this as well, that they want to extend the QBI deduction because it helped a lot of small businesses. So I think even though that is set to expire at the end of this year, I suspect that is going to go into some sort of a final tax bill. Individual income tax rates will also revert back to their pre-Tax Cuts and Jobs Act in 2017. And if that were to happen, the individual tax rates are going to jump up, especially on the top rate, back up to 39%. Individual tax brackets will also revert back to the pre-Tax Cuts and Jobs Act. Now, it's important to note that individual tax brackets are different than individual tax rates. An individual tax bracket essentially says how much money you can earn within a tax bracket to pay that tax rate. So during the Tax Cuts and Jobs Act, the brackets were made wider, which meant that people could earn more money and not get bumped up into a higher tax bracket. But those provisions are temporary. So unless something happens this year, they too will revert back to the pre-2017 tax brackets. The standard deduction is also set to revert back. In the Tax Cuts and Jobs Act, the standard deduction was nearly doubled to give people a greater tax deduction. But if that is not made permanent, then that's going to revert back to, again, about half of what the current standard deduction is, depending on whether you're married or if you're single or if you're married filing separately. The mortgage interest deduction is also another major one that's set to expire at the end of this year. Now, before the Tax Cuts and Jobs Act, the maximum mortgage interest you can deduct was up to $1 million of mortgage interest. But that got severely reduced to $750,000 of a mortgage interest. And if nothing happens at the end of the year, that's going to revert back to the $1 million of mortgage interest you can deduct. So I suspect that that will not get included in the final bill, because if it does expire, it gives people a greater tax deduction. They get to deduct an additional $250,000 of mortgage interest on their taxes. The child tax credit also got a big boost under the Tax Cuts and Jobs Act, essentially doubling it from $1,000 to $2,000 per child. The income eligibility threshold was also increased, so allowing more people to qualify for the child tax credit. But unless something happens this year with tax legislation and that is made permanent, that too will revert back to the pre-Tax Cuts and Jobs Act, essentially cutting that in half and also lowering the thresholds again. This could have a big impact on families, so I suspect this will be made permanent, but it's still unknown. But I think it's a big tax deduction that people have grown accustomed to, so we don't want to take that away, and I suspect the administration is probably not going to mess with that either. Another real big one is the alternative minimum tax. Now, the alternative minimum tax was created back in the 70s, and essentially it was a parallel tax system and essentially taxing what at that time was considered a wealthy. But it was never indexed for inflation. So as a result, it was capturing a lot more people who were not necessarily wealthy, but had to pay this alternative minimum tax, also known as the AMT. The Tax Cuts and Jobs Act essentially raised the threshold for the AMT and caused many people who were subject to the AMT to not be subject to that anymore. The AMT exclusion, or the raising of the AMT exclusion limit, is also set to expire at the end of this year. So it's uncertain what's going to happen with the AMT, if it's going to go into the final legislation. I suspect they're going to make that permanent as well, or do something with it, because if they don't, it could affect millions of people, because now they're going to be subject to the AMT again, especially with rising wages that have happened since 2017. Another item that's set to expire at the end of this year is the threshold for deducting medical expenses. The threshold for deducting medical expenses was lowered from 10% of AGI down to 7.5% of AGI, or also adjusted gross income. With the 7.5% of AGI, that means more people that have medical expenses have a higher likelihood of being able to deduct those medical expenses. But if it reverts back to the 10% before the Tax Cuts and Jobs Act, that means that fewer people are going to be able to deduct their medical expenses, which again could have a negative impact on people. So it's uncertain whether or not that too will get into the final legislation. But if it does not, it could have an impact on people paying higher taxes because they're not going to be able to deduct their medical expenses. So another wait and see proposal on what's going to happen with the deductibility of medical expenses and the threshold for that, whether if it's going to revert back to 10% or it's going to be made permanent at 7.5%. Another thing that was suspended during the Tax Cuts and Jobs Act was the miscellaneous itemized deductions that happened on Schedule A. So prior to the Tax Cuts and Jobs Act, there was a section on Schedule A where you itemize your deductions, where if you had certain expenses that exceeded 2% of your AGI, you were able to deduct those expenses. This is where people put their unreimbursed employee expenses, their tax preparation expenses, their investment advisor expenses, and a few other expenses that were part of that miscellaneous itemized deductions. Now, I don't know if this is going to come back because it really affected very, very few people. Essentially, any expense that was above 2% of your AGI, that's the expense that you're able to deduct. So it created a very low barrier, but it was very difficult for people to actually get that deduction. Another major item of the Tax Cuts and Jobs Act that's set to expire at the end of this year is the gift and lifetime exemption. That was drastically increased from $7 million up to almost $14 million per person. And unless that is extended, that's going to have a huge impact on a lot of families because now their lifetime exemption is going to severely drop down to that $7 million, although it's a little bit indexed for inflation, but it's going to be still a severely significant drop down from the almost $14 million. The personal exemption was another item that was eliminated during the Tax Cuts and Jobs Act, but unless there's new legislation, that's going to expire at the end of this year and it's going to revert back to its pre-2017 level. I suspect nothing's going to happen with that. They're going to let that revert back because a personal exemption essentially gives each individual a $4,050 tax deduction. So I talked about the items that are temporary from the Tax Cuts and Jobs Act that were set to expire at the end of this year. Now let's talk about some of the items that are permanent of the Tax Cuts and Jobs Act that are not set to expire. And I suspect no further action is going to be taken on these, but there may be some tweaks or variations to it. The first one is what I mentioned earlier, the reduction of the corporate tax rate from a maximum of 35% down to a flat 21%. Now, during the campaign trail, candidate Trump had proposed lowering that even further to 20% and even further than that to 15% if that corporation produced their products in the U.S. But I don't know how likely it is that that's going to get passed in the final bill, but that's yet to be determined. Another item that was permanently repealed was the elimination of the corporate AMT, the corporate alternative minimum tax. As I mentioned earlier, the alternative minimum tax on the individual was severely reduced because it reduced it increased the threshold amount. On the permanent side for corporations, they completely eliminated that, and that's not going to come back at the end of this year. The Tax Cuts and Jobs Act also permanently increased the Section 179 deduction to up to $1 million. Now, the 179 deduction essentially, in basic terms, allows a company to buy a large capital asset and expense the entire thing in the year they bought it versus spreading out that expense over several years, also known as depreciating that asset over several years. It also permanently expanded the types of properties that can be eligible for a Section 179 deduction. So things like HVAC systems, roofs, fire protection systems, and security systems are now eligible permanently for the Section 179 deduction. Another permanent aspect of the Tax Cuts and Jobs Act that's not set to expire is a limitation on business interest deduction. So before Tax Cuts and Jobs Act, there was no limitation on business interest that was deductible, but now there is a limit, and that's also permanent. Another item of the Tax Cuts and Jobs Act that was permanently eliminated was the deduction of the fringe benefits. These are things like entertainment costs and employee transportation costs. So 2025 is set to be a pivotal year for tax law changes. While it's almost certain we're going to see some sort of legislation because we have so many things that are expiring at the end of this year, the details of what's going to actually unfold is still a little bit uncertain. Although I mentioned earlier, there are certain things that I think are actually going to get extended or going to get into a final bill, such as the QBI deduction, the qualified business income deduction. But there's still a lot of other things that's still unknown. But one thing that is known is we're going to continue to stay up to date on any new tax law changes. And as soon as they become more clear, we're going to do more videos on this and educate everybody and all of our viewers.